The transition to a new global ledger does not begin with a public vote. It begins with infrastructure. Not with a dramatic announcement, not with a single currency replacing another overnight, but with payment rails, settlement systems, compliance layers, identity standards, and programmable accounting logic. Quietly becoming the default. Most people still think money is changing because money is becoming digital. That is too shallow. Money has already been digital for decades. Bank balances, credit cards, wire transfers, payroll systems, treasury markets, most modern money is already ledger-based. The real transition is not from paper to digital. The real transition is from fragmented ledgers to coordinated ledgers. That distinction matters. A fragmented ledger system gives individuals, banks, corporations, and jurisdictions different layers of friction. Friction creates delay, delay creates privacy, privacy creates optionality. A coordinated ledger reduces friction, but it also increases visibility, synchronization, and control. This is the structural tension behind the next monetary era. The public narrative is convenience, faster payments, lower costs, inclusion, efficiency, safer settlement. And all of those benefits can be real, but the mathematical reality is simple. When money becomes more programmable, the issuer and the regulator gain a larger surface area for policy transmission. That means monetary policy can move closer to the individual transaction. The silent transition is not only about central bank digital currencies, it is about the architecture around them. Instant payment rails, digital identity, tokenized deposits, stable coins, compliance automation, and global standards for settlement. The ledger is becoming the monetary battlefield, not because every actor is evil, because every institution responds to incentives. The old monetary system was built around banks as intermediaries. Central banks influenced liquidity through reserves, interest rates, open market operations, and balance sheet policy. Commercial banks transmitted that policy through lending, deposits, credit standards, and collateral. That system was slow, imperfect, and full of leakage. Policy moved through layers. A rate cut did not instantly become consumer spending. Quantitative easing did not directly enter every household account. Liquidity first moved through the banking system, bond markets, mortgage markets, and asset prices. This is one reason asset owners often benefit earlier from monetary expansion. That is the Cantillon effect. Those closest to new liquidity adjust before those farthest from it. When President Richard Nixon ended dollar convertibility into gold on August 15, 1971, the monetary system shifted away from a fixed external constraint. It moved toward a fiat architecture based on policy discretion. The Federal Reserve History Archive describes this as the beginning of the end of Bretton Woods. The structural consequence was not immediate chaos, it was flexibility. Governments gained more room to expand credit, manage deficits, and respond to crises. But the cost was long-term purchasing power dilution and greater dependence on central bank credibility. In 2008, Federal Reserve Chairman Ben Bernanke's crisis-era quantitative easing expanded the Fed's balance sheet. The Fed purchased agency debt, mortgage-backed securities, and later treasuries to stabilize markets. Again, the incentive was structural. When debt markets freeze, the system protects liquidity first, not because liquidity is moral. Because without liquidity, debt rollover fails, collateral reprices, and insolvency spreads. Now move forward. President Joe Biden signed Executive Order 14067 on March 9, 2022. It directed federal agencies to study digital assets, including the policy implications of a possible United States CBDC. Federal Reserve Chair Jerome Powell later stated in congressional testimony that a CBDC would require congressional approval. That matters because it shows the transition is not simply technological. It is legal, institutional, and political. A ledger is not just software. A ledger defines who can issue, who can settle, who can censor, who can audit, who can reverse, and who can access the monetary network. The institution benefits from visibility and policy precision. The user benefits from speed and convenience. The cost is optionality. And the explicit financial consequence is this: the more coordinated the ledger becomes, the easier it becomes to transmit monetary and regulatory policy directly into financial behavior. This pattern is not new. Monetary systems evolve whenever the existing settlement architecture becomes too costly for the scale of the economy. Gold settlement worked when trust between sovereigns depended on convertibility. Bretton Woods worked while the United States could credibly maintain gold convertibility at fixed rates. After 1971, floating fiat currencies worked because they gave governments flexibility in a world of expanding credit, global trade, and sovereign debt. But every new system solves one problem by creating another. Gold limited political discretion but constrained liquidity. Fiat expanded liquidity but weakened purchasing power discipline. Digital ledgers increase efficiency but concentrate observability. The same pattern appeared after the 2008 crisis. Quantitative easing stabilized markets, but it also made asset prices more sensitive to central bank balance sheets, real rates, and liquidity expectations. The monetary system became less about money as a neutral measuring stick, and more about money as an actively managed policy instrument. Now the digital ledger phase extends that logic. The European Central Bank moved the digital euro into a preparation phase starting November 1, 2023. That phase included work on a rulebook and possible infrastructure providers. That does not mean a digital euro is guaranteed, but it does show that major monetary authorities are preparing the rails before public adoption exists at scale. The economic parallel to today is clear. Just as fiat removed the gold constraint from monetary expansion, programmable ledgers may remove friction from monetary transmission. The most important consequence is not that everyone suddenly uses a CBDC. That is too simplistic. The deeper consequence is that the monetary system becomes more legible. When payments settle instantly, when identity attaches more tightly to accounts, when compliance becomes automated, and when assets become tokenized, capital movement becomes easier to measure. And once capital movement becomes easier to measure, it becomes easier to condition. This changes liquidity. In the old model, liquidity entered through banks and markets. In a more programmable model, liquidity can theoretically be targeted with greater precision. By sector, institution, behavior, geography, or account type. This suggests a future where monetary stimulus, taxation, restrictions, subsidies, and reporting become more integrated. Again, that is not a prediction of abuse. It is a structural observation. Programmability expands policy surface area. The Federal Reserve launched FedNow on July 20, 2023, as a 24/7 instant payment service. FedNow is not a CBDC, but it is part of the broader modernization of payment rails. Faster settlement reduces delay. Reduced delay improves efficiency, but it also makes the system more synchronized. Two observable patterns matter. First, money is moving from passive balances toward programmable claims. Stablecoins, tokenized deposits, CBDC research, and instant payment systems all point toward ledger modernization. Second, trust is shifting from institutional reputation toward infrastructure design. People will increasingly ask not only who holds my money, but what rules govern the ledger my money lives on. That is where Bitcoin enters the analysis. Bitcoin is not merely a speculative asset. Structurally, it is a monetary ledger without discretionary issuance, without a central balance sheet, and without policy committees adjusting supply. That does not make it risk-free, it makes it different. Its volatility is visible. Fiat dilution is often hidden inside purchasing power erosion, asset inflation, and negative real rates. A rational actor does not respond with panic, he studies the architecture. The clear positioning implication is this: in a world moving toward coordinated ledgers, monetary sovereignty depends on understanding three categories. Which assets are policy instruments, which are counterparty claims, and which are bearer-like neutral infrastructure. The silent transition to a new global ledger will not arrive as one event, it will arrive as defaults. A faster payment app, a new compliance rule, a digital ID standard, a tokenized treasury market. A central bank pilot, a banking integration, a consumer convenience. Then one day the old system will still exist legally, but the new system will dominate operationally. That is how monetary architecture changes, slowly in policy, then suddenly in behavior. The point is not to fear the ledger, the point is to understand it. A ledger can create efficiency, a ledger can reduce settlement risk, a ledger can lower transaction costs. But a ledger also defines power. Who writes, who reads, who validates, who reverses, who excludes, who inflates. These are not emotional questions, they are structural questions. And stewardship requires asking them before the transition is complete. If you understand the structure, you stop reacting to headlines. You stop confusing convenience with sovereignty. You stop treating money as only a balance on a screen. You begin to see money as a system of rules. And once you see the rules, you can position with discipline. This is 21 Protocol. Freedom is not a feeling, it's a structure. If you don't build yours, they will